Steve Sosnick and trader Keith Fitz-Gerald. Keith, you're a guy who always buys on days where we see sell-offs. Is that the case today, or does anything give you pause about what's happening on the screen at the moment?
Well, I tell you what, Liz, that's a great question, and thanks for remembering that. No, I don't worry a lot, or I wouldn't be very good at my job. Days like today are an engraved invitation to go shopping for the best names. And we laud people like Warren Buffett or the late Sir John Templeton. You buy at points of maximum pessimism when fear rules. Today is one of those days.
You know, speaking of Buffett, his annual shareholder letter for Berkshire Hathaway comes out tomorrow. And we all know this, right, Steve, that Warren Buffett has been a net seller of stocks. He has sold hundreds of millions of dollars worth of stocks starting, in the first quarter of last year, actually. And I think in the fourth quarter, he sold something like $6 billion worth of stock. So recently, Bank of America, Citigroup, DaVita. But it's not like he's not buying. He has picked up some names. So what does that tell you? Because he's the king of when people are fearful, like today, be greedy.
That was exactly what I was going to say, Liz. Because that's
that's
okay. You're entitled. It's your show. But that's the other side of what Keith is saying. Yes, you do want to buy when people are nervous. But right now, I think greed has been overtaking fear for months. So today we're seeing a little bit of a equilibrium in that right now. But basically, this has been a very greedy market because everybody's been chasing gains and it's been working for them. This is not a knock on that. But every so often you have to reset. And Walmart and the consumer sentiment and retail sales last week have all been causing us to reset, and we're resetting in a hurry today.
Well, it's interesting that you bring up Walmart, because yesterday Walmart was sort of one of the triggers, certainly for the Dow Jones Industrials. It was a big laggard. It had great numbers, but it did warn that there might be exogenous events. They didn't specifically say tariffs. In fact, John David Rainey, the CFO, told me yesterday they're not modeling for tariffs right now because they don't know what the tariffs will look like. But it felt like the market was looking for a reason to sell. And then today, they got a lot of reasons to sell. So what do you interpret from that, and what do you buy when others are selling?
Well, the one sector that's up today is consumer staples, which is a little odd if the theme is that consumers getting weaker. But you know what? You still need to go buy food and toilet paper and things of that nature. So those stocks are performing well. Low beta is doing better. Advanced decline's only about 2-to-1 negative on the NYSE. So there are stocks that are going up today. It's just the problem being we got so crowded into a select group of very highly valued stocks. You mentioned NVIDIA, you mentioned Walmart. These stocks trade with very high valuations. It doesn't take much to trip them up when that happens. And as to Keith's point, those can be times to search for values.
Well, Keith is one of those guys who actually has bought in over year after year into something like Palantir. I mean, your cost basis is unbelievable. You started buying many, many years ago, and you've made a ton of money. The forward PE for Palantir, which is falling about 3.7% right now, is 186. Keith, at what point do you say, well, it's going to take quite a while for the earnings to catch up to what people expect will be the actual price of the stock?
That is precisely the point, because if you're talking about something like cars or tractors where you're amortizing costs and expenses over long periods of time because accounting regulations require it, then high PEs are a problem. But what the accounting regs do not portray to the average investor is that high PEs are exactly what you want to see when a company is primarily digital, because those things are expense. So it presents a misleading picture. So on a company like Palantir, I don't fear that, because the return to scale in the years to come means they add every incremental customer at virtually no expense.
Yeah, and short at your own peril when it comes to Palantir. I'll tell you that when you look at consumer discretionary, and we could put up some of these ETFs that would include retail, but Want, for example, is one of those derivative ones where it's 3x. So every gain, you get 3 times the amount. Every loss, you get hit 3 times. So right now, Steve, it's not the moment, but every time I've seen these ETFs sell off for just consumer discretionary, they come roaring back.
They typically do. I'm not a huge fan, by the way, of leveraged ETFs, because one of the things that people lose sight of, Liz, is they match the 3 times the daily move. But over time, they have to buy either have to buy options that decay, or they have to roll futures positions. So you have to do it on a daily basis. So you have to be careful. Those are trading instruments, not investment instruments. But you're right. That shows the buy the dip mentality that comes in. We see our customers buying every dip and roaring back. And when they do buy the dips, they tend to buy a lot of the double and triple levered ETFs to maximize that bang.
Keith, What did you buy today?
Palantir, Nvidia. I went shopping yesterday for Apple and Microsoft. You know, again, we already own the dividend things. We already got the low betas that Steve talked about, and he is so spot on this. But you want to look when everybody's on one side of the boat. You want to look at the other side. Call volume in many instances going up today, which tells me they're already positioning for a rebound. When that happens, I have no idea.
Okay. Well, I'll tell you what's happening right now. NASDAQ is down 2% and Steve, the Russell 2000 getting hammered the most. And yet, usually when the tariffs are at the heart of the fears, which appears to be the situation at least today in relation to the consumer sentiment number we got that was worse than expected, that's something that small and mid caps are usually inured to, right? I mean, they don't import a ton. Usually they're more insular when it comes to the United States. Why are they getting smacked so hard?
Because I think it's a second order effect. I think the tariffs have the consumer nervous, but now the nervous consumer has everybody concerned that the whole economy is slowing down. Remember, consumer's 2/3 of the economy. So if you take that down, that's a negative impact on the economy. And the fact that bond yields are screaming, not 7, 9, 11 basis points, that's telling you that there are just generalized economic fears out there.
Well, there's a real flight to quality right now. You've got the 10-year yield at the low of around December 17th. Yeah. So that tells you that there is that flight to safety, although gold, oddly, is down. Maybe it's just after 8 weeks of gains, right?
Gold's a little fluky.
If I may, Liz, don't forget there's something else at work. This rise of passive investing and all the indexing that's take place. Now the computers are duking out because what started as selling is now computers having to catch up. So it becomes a race to the bottom. They're trading so fast that humans can't keep up. So the best thing to do is take a breath, step back, when in doubt, zoom out, a key phrase around here, and focus on the quality. Focus on the stuff Steve and I were just talking about.
I'll focus on that and focus on getting the edge, Charlie. You got to get the edge. That's what Charles Payne's mentor used to tell him. So this is interesting on a day like this. Steve, Keith, have a great weekend.